Okay, so we should be good to go. All right, so let me share my screen and let's begin. Let's start that paper, start going through the questions in this paper. Screen. There we go. All right, should be seeing my screen. So this is a paper that we'll be looking at. All right, so let's start with this question. So we have 20 multiple choice questions to go through first, and then we have the more constructed response question. The first question asks, what is the company's per annum weighted average cost of capital for investment appraisal? Did we give this an attempt? Do we have an answer? You can respond in the chat if you wish. What do you have as the answer for question 1? No, I will share the model answer response. However, this might not be the way you were working it. So this is pretty much what you would get. The cost of equity is already stated. The cost of debt, you know what the cost of debt is. You just need to do it net of taxation. Now they did tell you there are 11% loan notes and they put 100. Now, what does that mean? Why we know that we didn't need to do any further calculation is because they're letting you know that the market price for the loan note is 100. And if the par value and the market price is 100, it means that the market price is reflective of the original value. So the 11% would be the cost of debt. So nothing would need to change there. So you would need to use the cost of debt formula for loan notes. It would need to do that for redeemable debt. It would need to work with the IRR, doing the present value. It would need to do that part because what they are trading at par. I mean, the market value and the par value is the same. Market price is 100, par value is 100. So the interest rate is indicative of the cost of debt. So that would be for question 1. Now, question 2 have some information. Question 2 now says, what is the annual finance cost if the management reduces the collection period to 60 days? All right. So based on that now, what we'd have to do is work out what is the current collection period. Now they tell you that the management, they have annual credit sales of 20 million and the AR is 5, right? They didn't give you the days, but them tell you the receivables is 5 million and the credit sales is 20 million. They say assume a 365-day year. So what you're gonna have to do is put the receivables over the sales times 365 to know what's the receivables days. So that formula is what you have to use. So you'd have to say, okay, if the receivables is 5 and the credit sales is 20, so it's 5 over 20 times 365. That's going to give you 91 days, right? So right now, it is 91 days. And then they ask you, what is the annual finance cost saving if the management reduces the collection period to 60 days? So now it is 91 days. What they're asking you then, what would be the finance cost if it got down to 60 days? So here what you're going to do. What we're going to have to work out now is we're going to have to say to ourselves, that means we need to reduce it by 31 days. So we have to go work out, all right, what is 31 days worth of receivables? Or if you don't want to do that, them say reduce it to 60 days. So we can say, all right then, 60 over 365 times 20 million to get what the figure is supposed to be, right? We do 60, because 60 days I want it to be, over 365 times 20 million, right? And that's supposed to give you a figure that will give what the receivables will be, the new receivables. And then if overdraft is 12%, work out 12% on that. And when you do that, you should get A as your answer. Once you do it like that, then you should end up getting A as your answer. So yes, they did it a different way, but pretty much like the same result. So that maths that they do there, you probably wouldn't work it like that. But to get the finance cost, we'd have to say, all right, if it's 60 over 365 times the 20 million, that will be my receivables, and the overdraft will be 12% of that. That's how we could work that out in terms of the finance costs. Right? Because you probably wouldn't do it like how they do it here. But what is the easiest way to understand it? They say, what is the annual finance cost savings? Now, what they did here is basically just work out from the savings direction, because you would have to work out the finance cost at the 91 days, the finance cost at the 60 days, and then subtract it to know how much they save. What they did was say, all right, you're reducing it by 31 days, right? So I don't think that math there is correct. Take out my calculator. Let me see if there's something on the screen that's a little off. Maybe it is right, but let me just make sure. So you're reducing it by 31 days to see how much you're saving. So 31 over 365 times 20. Second. $31 over 365 times 20 million. Yes, that is actually correct. So give it a 1.698 million. All right. Yeah, so give it a 1.698 million. So that is actually correct.
Sir,
Yes.
what if you use the 60 days? Because that's what the formula that I use, and it kind of throw you off there a little bit. Because when I get the receivable for the 60 days,
Yeah.
and I minus it from the 90 days and do the finance cost, it was 105.
Uh-huh.
And that wasn't one of the option there.
Right. Basically 105 basically is what it is at. So I think what they do, they're just trying to work out the savings, because we would have to work out the finance. All right, so you get 105, right? That's what you say you get? 105,000 something? So here what we're going to do now to make sure so we get the other part. When you do the 5 million times 12%, what we get? 5 million times 12%. The 5 million times 12% is 600,000, right? 5 million times the 12%, 600,000. Cool?
Yeah, it was 600,000.
Right. All right. And then if we do 60 days, 60 times 365 times the 20 million, give us 3 point something million, 3.2 something, right? When we do, so that will be the new receivables. When we do 12% of that, we get 390 something thousand, right? So then you do 600,000 minus the 390,000, you can get the 200,000. So that's basically, so it's like the way they did it, they just work it out of. The only mistake that is here in the answer is they put 712. It's not 712. It's the 1,690,000. You see the 31, the reduction 31 over 365 times 20, give you 1,690 something thousand. That's what I give you. And then to know what would be the finance cost savings, it would be 12% of the 1,690 something thousand. Right? So it's a typo this in the model answer. With this, yeah, that 712 is not the figure that's supposed to be there. It's just supposed to be 12% of the 1,690 something thousand. And then that will get the 200,000 as the answer. Yeah, so that's a little glitch right there in that one. All right, so for question 3, another working capital, it asks you for what is the length of the working capital cycle? Well, that's just additions and subtraction. You should get A, 68 days. because it should be 50 plus 21 plus 14 plus 28 minus 45. The only thing that needs to be subtracted here is the payables, because everything else there are assets. So you add all of them and subtract the payables, you should get 68 days. And that should be your answer for question 3. Question 4 is basically here. Which of the following are stakeholder groups for a listed company? Quickly, all of them. 1, 2, 3, 4. All of them are stakeholder groups for a listed company. Question 5 now give us some other maths. It says, are now companies contemplating purchasing for 300,000 a machine, which will be used to produce 50,000 units of a product per annum for 5 years. These products will be sold for $10, unit variable cost 6, incremental fixed cost 70 per annum, for production cost 25,000 for selling and admin costs. Now, Ireland requires a return of 10%. By how many units must the estimate of production and sales fall, the volume fall for the project to be regarded as not worthwhile? So what I'm really asking you to do, is do an NPV and then calculate the sensitivity of the sales volume, which is the present value of the contribution, calculate the sensitivity of that, right? So for that one, it just share, I don't know if you attempted it, but in terms of our set of workings for that, we could put this. This is your template. So your machinery, the cost, the annual contribution in annuity for 5 years, and the annual fixed cost in annuity for 5 years. Do your discounting, you get a present value of $98,055 positive NPV. Now to work out the sensitivity of how much units it must fall by, then you're going to have to use the present value of the contribution. Now we normally do is really the NPV over the present value of the cash flow you're considering. So it would be the NPV 98,055 over the present value of the contribution, which is the 758,200. When you get that now, that percentage multiplied by how much they were selling originally, 50,000, to know how much units it have to fall by so that the project will no longer be worthwhile. It have to fall by 6,465 units. It have to fall by that amount for it to be no longer be worthwhile, or to be no longer worthwhile. Now moving on to question 6. So these two are quick theory. Question 6. When using the expected value criterion, it is assumed that the individual wants to C, maximize return irrespective of the level of risk. When we use expected value, so C would be the answer for number 6. When using expected value, the individual really want to maximize the return. They are not concerned about the risk. Number 7, according to M&M, the cost of equity will always fall with decreased gearing because why? The return to shareholders becomes less variable. That's C. That's what M&M says. That the cost of equity will always fall with decreased gearing. It always go down when gearing go down, right? Because the return to shareholders become less variable. What they're saying is that if there's less debt, the shareholder, they are fine with getting a lower return because now they don't stand that risk of losing their capital because, debt takes priority in terms when there's a point of when you have liquidation. So now they'll be more relaxed because they will say, all right, less financial risk, I can take a little lower return. So C would be the answer for number 7. Questions 8, 9, and 10 are also theory. Question 8 says, what is the purpose of hedging? Again, the purpose of hedging is to reduce or eliminate the exposure to risk. So that C is the answer for question 8. So the purpose, reduce the exposure or even eliminate the exposure to risk. Question 9 says, Lytham Company is a UK company trading in Southeast Asia and remitting profits to the UK. The directors are considering methods that they can use to minimize their exposure to foreign exchange risk. Which of the following will not protect them from exchange risk? Which of the following will not protect them from exchange risk? So ask ourselves, Lightham is what kind of company? A UK company. Okay. So what the UK company is concerned about is that wherever else they are trading, that if they are remitting money to the UK, they don't want the UK, this pound to get less. They don't want it to be less pound with sterling's coming in. All right. So let's look now. Which of the following will not protect them? Matching will protect them. Because what is matching? Matching basically is if you're earning in Asian currency, and you have expense in Asian currency, then use those money to do that, right? So use the Asian money to pay Asian bills. Use sterlings to pay sterling bills, right? You have a sterling account and an Asian account. For any Asia transactions in that currency, use the Asia account. If it's a sterling transaction, use the sterling account. So matching is fine. The next one is forward contract. Yes, man, forward contract is one of the known hedging techniques because you're trying to lock in the rate so that you don't lose out. So B is correct as well. C now, invoicing in Asian local currency. No, that don't make sense because you're not an Asian company. You're a UK company. And if the Asian dollar changes, let's say it moves unfavorably, right? When they are remitting sterlings to the UK, what is going to happen is that less pounds going to come because whatever in the Asia, when it's in the Asian dollar, you have to go convert it. An unfavorable movement will mean that they're going to collect less pounds, right? So that one it will not protect. So C is the answer, but let me read D as well since we're learning while we go along. D now, leading and lagging. Leading and lagging basically is the ones that you expect the currency, the rate to move unfavorable. You lead, you pay those quick because you don't want your bill to go higher. And lagging is you hold out on other bills that it's not going to affect you in terms of exchange movement. So for argument's sake, the Asian company will want to cover the UK bills quick, right? But what they're going to do when the Asian vendors that are suppliers that they have, they're going to take them time to pay them because they're saying, hey, the dollar you owe me as Asian I'm earning in, and I owe you in Asian. I'll take my time because the bill not going to go up. It's not going to increase. Right? So that one is fine. So C is the answer for number 9. So number 9, the answer is C. Now question 10. So we have a few theory here going through quickly. Question 10. The higher risk of a project can be recognized by decreasing what, right? So the higher risk of a project can be recognized. How you know that it's higher can be recognized by what? A, the cost of the initial investment of the project. No, man, the cost of the initial investment doesn't suggest that it is risky at all. Some things require a lot of money. Some things require less money. B, now, the estimates of future cash inflows from the project. So this is possibly one, but let's read through. So this is possibly one. Why? Because future cash flows are not predictable. They are not fixed. So things may change. So those are, if you realize that they're expecting a heavy future cash flows, that seems to be even a higher risk. I suppose they don't get any cash flows coming in since it's a startup or a new project. See now, the IRR of the project. No, man, the IRR, it's one of the things is the cost of the initial investment and the IRR, they are independent of how risky the project is. So the money we're going to spend initially and the IRR, they're independent of the risk of the project. The IRR just basically say how much you need, what is the cost of capital that you're good with, pretty much. Which cost of capital you're okay with. So it has nothing to do with risk. And D now, the required rate of return of the project, right? So D says the required rate of return of the project. Now, the thing is, you see, the higher the risk of the project, what we have to realize is that is actually the greater is the required rate of return, right? So they don't really give that. Remember we said they said by decreasing, that's the key word. They say the higher risk of a project can be recognized by decreasing, that something decreasing, right? The required rate of return, if it is decreasing, it means it's not so risky because the investor is saying, hey, I don't need 10%, man, 5% good. That's basically what it says. So that don't mean it risky. So part B now look like the answer because if the cash inflows are getting less, if those are getting less, then it means that this project is really risky because it might not recover all the money you spent at the start. So B as in boy is the answer for number 10. Question 11. An investor who bases all his investment decisions on information he has gathered. Now, where am I getting it from? Public statements and comments on company plans and performance is acting as if he believes that the maximum level of efficiency of the capital market is it strong, semi-strong, weak, or a zero? Well, there is no such thing as a strong market, right? A strong market means that the share prices reflect all information publicly available, privately available, even what nobody knows about, right? So that's strong, meaning it's just a perfect market. There's no perfection in capital market. So part B now, semi-strong pretty much means that the share price is reflecting information from the past and information that has been made publicly available, right? So that's what semi-strong means. So semi-strong basically is saying, all right, it includes past information and publicly available information. All right. Weak now means that it includes past information, right? But nothing else, meaning that it doesn't reflect public information. It doesn't reflect privately held information. So let's look at it another way. When a market is strong, nobody believes that they can gain anything from anything. And that's why there's no such thing as a strong market. When a market is semi-strong, people believe that when they have inside information, they can make a profit. They have an advantage. So they have some inside information. That means they can make a profit with the inside information as to what to purchase, what to buy, what to sell, when to purchase shares, when to sell the shares. That's if it is semi-strong. They believe they can use insider information. If it is weak, they believe they can use public information, because what they believe is the only thing the share price reflect is past information. So if they get some public information and some privately held information, some insider information, they believe that they have an advantage, a favorable advantage in terms of when to buy or sell shares. All right. So based on this investor is making decision based on public information, right? So what that means is that he believes that the share price don't reflect public information, right? Now, strong reflect public information, semi-strong reflect public information, but weak does not reflect it. So he believes that the market is weak. So for number 11, the answer is C. C is the answer for number 11. Number 12, calculation, but a very
Hold on,
quick
sir, sir. I
Yes.
didn't get how you come to weak.
Yeah,
I was
because
looking at semi-strong.
no, semi-strong would mean that the only way he can get an advantage is if he have inside information, because semi-strong means that the market prices already reflect information from the past and information that has been made public. So that's what semi-strong market means, that the market prices already reflecting what is from the past and public information. So him gathering this and reading it is wasting his time. He is wasting his time if he thought it was semi-strong, because if it is semi-strong, it don't matter if him reading it or not. The share price is the share price that you're seeing on the stock exchange. So that share price is that, and nothing is going to change with that. So the only way that he believes he can make use of it is because he believes the market weak. So he believes that nobody's reading these public statements. So if he reads it, he will be ahead of the game. So that's the thing. That's why he believes the market is weak.
Okay, just getting it now, sir.
Yeah, man, no problem. All right, so question 12. What is the cost of the preference share? No, they're dropping corporation tax in it. They don't waste with time. There's no such thing. Preference shares don't have no tax relief. So really and truly, it is the interest over the market value. What is the interest? 6% on the dollar. That's what them said. 6% on the dollar. That's 6 cents over the market price, 65 cents. So 6 cents over 65 cents, 9.2%. Apple. A is the answer for number 12. And then you move on from number 12. So we have some more theory here. Question 13. Which of the following is not one of the three main types of decision facing the financial manager? What we do know, the financial manager have investment decision, financing decision, and dividend decision. We know those three. So anything out of that is waste of time. So C is the answer. Income decision, no, sir. That's not their job at all. Question 14. Compared to ordinary secured loan notes, convertible loan notes are, let's see, likely to be more expensive to service because of their equity component. No, man, not at all. Because of the equity component, more expensive meaning about charge a higher interest even though they can convert to ownership. Not at all. Part B says likely to be less expensive to service because of the equity component. No, that we don't even need to read further. It's likely to be less expensive. Why? Because the man will take less interest because he knows after a period of time, he owns a business. He has shares in the business. He's a part owner of the business. Right? So he will take less interest to get an equity stake in the business. So B as in boy, that's the answer. Question 15. Which of the following is the correct statement of the conclusion of M&M on the relevance of dividend policy? Now, this basically is a knowledge-based, a tutorial-based question. So I'll go straight to the answer. So what is the correct statement? It would be D. The value of the shareholders' equity is determined solely by the firm's investment selection criteria. So that is the answer. That is the correct statement regarding their conclusion with regards to dividend policy. How much to issue? Should we retain? Should we have a policy in terms of percentage of profit, whatever it might be, a minimum dividend or, whatever it might be. So the answer is D as in dolphin. The value of the shareholders' equity is determined solely by the firm's investment selection criteria. Now, question 16 now. A company is going to take on a project using a mixture of debt and equity financing in an economy where the corporation tax rate is 30%. All right. Assuming perfect markets other than tax, which of the following statements is true about the finance used for the project? All right. So here what we're going to do now, we're going to use a process of elimination. First, one thing we had learned is that the equity beta is carrying 2 babies in the womb. The asset beta is only carrying 1 child. So one thing we do know is that the equity beta will always be greater than the asset beta. That's what we are sure about. Nobody can throw us off with that. So we know the equity beta will always be higher than the asset beta. So the only answers that start out with that is A and C. B and D is a waste of time. We wouldn't read anything further on that, right? So equity beta always higher than the asset beta. So the answer is between A and C. Let's continue now. Let's continue. The other part says the WACC is less than the cost of equity calculated using the asset beta. Yes, because the WACC is the middle. The WACC will always be lower than the cost of equity and higher than the cost of debt because the WACC is always drop in the middle, right? So they say using asset beta means you have no debt within this thing, right? They say the WACC is less than the cost of equity calculated using the asset beta. Unfortunately, both of them saying the same thing, so that has to be right. That is actually correct. The WACC going to be less than the cost of equity using the asset beta. Again, as we say, normally, just an easy way to remember it is that the WACC is an average, right? And the cost of equity is normally the highest of everything, right? Cool. So let's continue now. Then it says the WACC will be less than the cost of equity calculated using the equity beta. Now again, as we said, the WACC always going to be less than the cost of equity. The cost of equity is at the top, the cost of debt at the bottom, the WACC is the average of the two in the middle. The WACC higher than the cost of debt, but lower than the cost of equity. Don't matter if it's asset beta or equity beta. So A would have to be the answer, right? So A would be the answer because the cost of equity is going to be less than the WACC. Whether you use asset beta or equity beta, it don't matter. So Apple, A is the answer for question 16. Question 17. Which of the following is not a source of finance within the Islamic banking model? Which of the following is not a source of finance? So murabaha, that is trade credit, so that is a source of finance. The sukuk, lease is a debt finance, right? So that's debt finance, so that is a source of finance. Kataba, there's no such thing. I mean, kataba just is really to write, but that's not a banking source of finance. Mudaraba is equity finance. So, okay, the murabaha is financing. Sukuk, debt finance. The mudaraba, equity finance. We also have the ijara, which is the lease. That is the lease financing. So those are financing methods. But the kataba, no, that just means to write. That is not one of the financial instruments in Islamic finance. So C would be the answer for question 17. Question 18. A script issue, normally called also known as a bonus issue, with perfect information. What does it do? Does it increase the market price? Of course not, because people getting some free shares, so it's not going to increase the market price. Next one, increases individual shareholder wealth. No, sir, because a free you get it, right? So it's not increasing your wealth. Or some free shares, it don't increase the individual shareholder wealth. What it does, it increases the number of shares. When it don't affect the value of the company, that's what we do know. Next, decreases the debt or to equity ratio of the company. No, it doesn't. It doesn't at all. But decreases the EPS. It does. Why? Because now it's more shares. Is the denominator is now bigger. So you have your profit after tax over your number of shares. Now your number of shares is a larger number. So the earnings per share will get less. So D as in dolphin is the answer to question 18. Now, question 19. A company has a money cost of capital of 19% per annum. The inflation rate is currently 6% per annum. What is the real cost of capital? All we need to do is use the Fisher formula for that one. We just need to use the Fisher formula and we should be good to go for that one. And utilizing the Fisher formula, you're going to get the real cost of capital to be 12.26%, which would mean the answer is A. So that would mean just by utilizing the formula to calculate the Fisher formula, plug in the real rate is what we're trying to find. So you plug in the money rate that you have of 19%, plug in the inflation rate you have of 6%, do the math, and then your real rate will become 12.26%. And then now question 20. It says, all of the following are variables that can be manipulated to affect fiscal policy, except, all right. So what first thing we need to remember is that for fiscal policy, that is for what the government focus on with fiscal policy is taxation and government spending. That's what we're going to be remember, right? So for fiscal policy, taxation and government spending. For monetary policy or the Keynesians, what we do know for monetary policy is that they utilize interest rate and money supply. So let's look at the answers. It says these can manipulate fiscal policy except A, personal tax. Well, that's fiscal. Government spending, that's fiscal. Government spending, that's fiscal. Rate of interest, no, that's monetary policy or Keynesian policy. So D as in dolphin is the answer. So as we said, fiscal policy focuses on taxation and government spending. Monetary policy or the Keynesians, they focus on interest rate and money supply. So that covers the 20 MCQs, 20 multiple choice questions. Now we have these ones to look at, these ones to attempt. We're gonna go through these as well. So I'll just give you, I'll just give you a couple minutes to read it and then we're gonna go through the question. I'll give you a couple minutes, maybe 3 minutes to read it. Then we're gonna go through the question together. All right, so give you 1 more minute and then let's discuss it. Let's go through it together. Let's go. See how we do this. There, 1 second. All right, so let's look at this question. It says calculate the cost of the current ordering policy and calculate the cost of the current ordering policy and determine the saving that could be made by using the economic order quantity model. All right. So let's see, how do we do that? The first thing is, because what we have to look at is the current ordering size now, based on what they have. They told us that they expect the annual demand to be 255, 380. All right? Tell you what the product selling for, they place an order for 50,000 units regularly. So that's the ordering quantity, right? 50,000 units regularly. So the number of orders is going to be 255, 380 divided by 50,000. The average stock going to be the order quantity divided by 2, which is 50,000 divided by 2. The annual holding cost is going to be basically the average stock times the holding cost per unit. Now, what is the holding cost? Is that the cost of placing order is 25. The storage cost is 10 cents. You multiply that by 10 cents. All right. So that's in essence the current policy. The other policy is using the EOQ, calculating the EOQ, and then looking at the stock costs. So let's go through this question based on the information that we have. So, all right. So we said TNG has a current order size of 50,000 units. Average number of orders per year, 5.11 basically. So ordering cost going to be the number of orders times the ordering cost per unit. The holding cost is going to be the average stock, which is Q divided by 2, the 50,000 divided by 2, times the holding cost per unit, the 10 cents. You add up those, you get $2,628. Now, if they use the EOQ model, they calculate the EOQ, they get 11,300. So each time they should order 200 and each time they should order 11,300 based on the EOQ. What would be the ordering cost? 565. Holding cost 565. So the annual cost 1,130. So how much would they be saving? They'd be saving $1,498. So that's what would be their savings. All right, and that pretty much covers part A. So it's really working out your ordering costs, working out your holding costs, adding it up. Then if you use EOQ, calculate the EOQ, then work out your ordering costs and your holding costs, add it up. The difference will be the savings. So that pretty much is the part A. The part B now says determine whether the discount offered by the supplier is financially acceptable to TNG Co. Right, determine whether the discount offered by the supplier is financially acceptable to TNG Co. All right, all right. So we're gonna have to look at what the discount is. It says TNG normally pays trade suppliers after 60 days, but NKR has offered a discount of 1% if they pay within 20 days. So them want to pay 40 days earlier. So let's look and see how that will work out. How will that work out, right? So they're trying to tell them pay earlier. So let's see now. What is payable if the discount is taken, right? The payable is going to be 20 over 365 times the 2809 180, right? So that's what the payables is going to be, right? Okay, so let's see something now, because if that is what it's going to be, sorry, hold on a second here. All right, and how we get the payables figure? How we know that that's what it's going to be? It's going to be based on the purchases, right? Because 255,380 units they buy, right? And they pay $11 for it. So 11 times 255, 380 give us 2.8 million. So that's what is the total purchase. Now, if it's 20 days they're going to take, 20 over 365 times the 2809 give us 153,928. All right. The payables then is going to reduce from 461 to 153. So that's a reduction of 307,000. That means the people have to go fork out some money now, you know. So the finance cost, the interest is going to be increased because they don't have the money. They're going to be using the overdraft. And the overdraft interest is 8%. So they're going to increase their interest that they pay 8% of the 307, 24,000. But the discount they get is going to be 1% of the 2.8 million. That give you 28,000. So the net benefit is $3,000. So it makes sense because they're making more money. They're spending 24,000 more, but they're saving 28,000 more. So they are getting a net benefit. So yes, the discount, it is financially acceptable. That's another 5 marks. Part C says critically discuss the limitations of the EOQ model. Now for that, yes, you can. What are the main issues here? With the EOQ, the total cost of having inventory is minimized when holding cost is equal to ordering cost. That we know. However, what are the limitations? Demand for inventory holding costs per unit per year and order costs, they're assumed to be certain and constant. But we know that in real life, that's not necessarily the same. You can't know that is this amount you're going to sell for the full year. Highly unlikely. The cost to hold inventory will also fluctuate. And even the ordering costs, you can't keep that fixed. You can decide that it's going to remain the same figure for an entire year. The other issue is that the EOQ, it ignores the cost of running out of inventory. It ignores stock out costs and the loss of goodwill, right? And another thing is that this EOQ model, the third issue is that it was developed on the basis of zero lead time and no buffer stock, meaning when you order, you receive. But we know that's difficult in terms of practical application. That is not in all situations or all scenarios at all. And that basically covers your question 1. So now I'm going to give you some time to read question 2 again, about 5 minutes maximum. Read it and even start attempting it, because we're going to go through the entire question like what we just did, right? So I give you probably 5 minutes, put some thought to it, and then we're going to go through the full question 2. So 5 minutes, and let's discuss, let's go through question 2 after. Okay, so let's go. Question 2. It says, assuming the finance was raised via a rights issue, calculate the theoretical X rights price. All right. Okay. Calculate the theoretical X rights price. So based on that information, what you need your number of shares, right? You need to know how much they're going to raise after the rights issue. And the theoretical X rights price is normally what? Your market value plus the amount of money they raise from the rights divided by the new number of shares, and that will give you the theoretical X rights price. The part B then asks you to evaluate and comment on the operating gearing and the financial gearing, and up to 4 marks available for the analysis. So not a heavy question. So let's just look on the solution for this and go through it. So now in terms of the number of new shares issued, we know say $6 and it's 9 million they need to raise, and it's $6 is the rights issue. That we do know. All right. So that being the case, 9 million over 6, 1.5 million. So the new number of shares is going to be the original 12 million shares plus another 1.5. So 13.5 million shares they have in total. So what is the TERP? The total market, the market value of the first 12 was $8.40 per share, $8.40 times 12 million. Plus now, the 9 million that them raised from the 1.5 million shares, and you put that over the new number. So that will give you 109 million over 13.5 million, $8.13 is the theoretical X rights price. Now in terms of the operating gearing, course, what we're going to utilize, they gave us the table, right? So they did give us the table, and normally that's your fixed cost of sales. So you'll notice it's going to be your fixed cost of sales over, when you're going to look on all those other variable costs. So, you know, the 32 million that you had for variable cost of sales, the 16 million that you had for your administrative costs, right? And again, the 9 million for the fixed costs, right? So when you're looking on that, a fixed cost over the total cost, that's where you get operating gearing. Fixed costs over total costs. The current operating gearing, that number is there. The proposed based on the forecast, that number is there, right? So 16, so based on the forecast, they expect the proposed fixed cost to be 16 million. And of course, they give you the other cost, which is the administrative cost. So the variable cost, the fixed cost, and the admin cost, they give you those. So you're just utilizing the table to get those two. Then they say they want a discussion on the operating gearing. So I'm going to share this with you all at the end of the session. And that pretty much would cover in terms of the financial gearing as well, the current financial gearing, the proposed financial gearing with the debt issue, the proposed financial gearing with the right issue, and then you give your commentary on it. And that basically covers question 2. The question 2, a little bit of theory and just ensuring that you know the formulas. Question 3 now is again, just the part A is mainly the calculation. The part B is an illustration that they tell you can do calculations for that as well. So question 3, I want you to go ahead and read it. Again, try to start it so you can do, because we're going through the whole question, the full question all at once. So read it so I understand from it, give it a start, and then let's go through the entire question. So I'll probably give you again, no more than 5 minutes. So just use 5 minutes, read through, give it a start. And we're going to go through parts A and part B. All right, so let's go. Let's look at this one. Just reshare my screen. So this one, it says, evaluate which of the two machines should be purchased by considering the equivalent annual cost. Okay, which of the two machines should be purchased by calculating the equivalent annual cost? List any other factors the company should consider before choosing which machine to buy. And then part B says, explain and illustrate the return on capital employed and payback approaches to investment appraisal. You should use numerical examples and detail the advantages of each. So they are asking you, give them some numbers and explain it, illustrate using numbers. So that's what they are expecting from you for question 3. Now, the equivalent annual cost, as we know, the relevant cost normally will be the initial cost, the running cost, and the residual value. So those are the things we need to take up, right? And when we're using our equivalent annual cost, what the first thing we need to do is calculate the NPV of each cost. And then when we do that, we calculate the equivalent annual cost by using the NPV of the cost over the annuity factor for that period of time. So if it's a life cycle of 6 years, then the annuity factor at year 6. If it's a life cycle of 4 years, then the annuity factor at year 4. So that is pretty much what we call the cumulative discount factor. So that's pretty much how you would go about calculating the equivalent annual cost. So with that approach, based on the information for machine alpha, the initial cost in time 0 is 400,000. The annual running cost is 20,000. That's after tax for 6 years. And in year 6, the residual value is 100. Those are the three, as we said, the cost, after the running cost, and the residual value. Now you have all that information. They said the discount factor, the cost of capital is 10%. Calculate the NPV, you get 430,700. It's negative, but that's fine because we're trying to determine which one of them costs cheaper. All right. So the equivalent annual cost then is going to be the NPV over the annuity factor year 6 at 10%, which is 4.355. So that gives you $98,900. Now for the Bravo, same thing. The initial cost is $290. The running cost after tax is $25,000 for 4 years in this case. And then in the 4th year, you sell it, it's the residual value is $65,000 inflow. So do your discount factor 10%, your annuity factor for year 4, and then do the maths, the NPV. Then when you get the 324,900, you don't finish yet. You need to divide it by the annuity factor at year 4. Since this one is a 4-year life, you get 102,600. So even though the NPV or the cost of the alpha is 430,000, when you annualize it, the alpha is cheaper. The alpha is preferred because the alpha gives you 98,900 as the equivalent annual cost versus the Bravo, which is 102,500 as the equivalent annual cost. But what other factors you need to consider? The reliability of the machine, whether or not the supplier is going to give adequate service, what your experience with the supplier before, and whether or not the supplier will offer cheap finance or leasing terms. So let's look at that. And then the part B now says explain return on capital employed and payback using numbers if you wish. So you give the formula, explain what it is. Payback, explain what it is. And then they say here what? Use some numbers for your example, and then you should be good to go with that question, right? So that pretty much completes the question 3. So we have 2 more left. The question 4. And probably I'll just give you 3 minutes to read this one so that we can just go straight into it, right? So just use 3 minutes to read the question 4. Let's go straight into it. Question 4, let me see what it's really about. Okay, business valuation, short one. So yeah, use 3 minutes, read the question itself, use 3 minutes, read it. Let's go through the entire question, and then we will look at question 5 as well. Not a lengthy question again. So yeah, let's do that. So 3 minutes for read question 4, and then let's just go through the full question, and then similarly we're gonna do use a similar approach for question 5, and then we will end there. My internet is quite faulty, so I'm unable to really try a quiz. I will say I'm pretty much I'm not even getting on the website properly. I'm surprised that the class is running so smoothly, but I'm not getting on sites at all. All right, so go ahead, read, use 3 minutes, read it, and then we are going to go to question 4. All right, so let's go. Question 4. The first one says calculate the value of the company using the following methods. 1, the net asset value, and 2, the PE ratio method. The net asset value basically is going to just look at your assets minus your liability, but you're going to just adjust them where necessary. So based on the information given, they had given you a balance sheet, a statement of financial position. However, they had indicated that it had been, they had given you something. They had said, for example, the freehold property has not been revalued for a number of years, and it is thought that its current market value is 1.3 million. All right, okay, yeah, I hear you, but let's see what's going on. So they said they believe it's 1.3 million. All right, so okay, and what else did they say? No, they said it's also been discovered that the inventory value at 100 is obsolete and could only be sold as scrap for 10,000. Oh, okay. So they basically saying the inventory gone down by pretty much $90,000 then, right? Okay. So they're saying that the market value of the freehold property gone up to 1.3. The inventory gone down by 90,000. What else them said? What else did they say? They also said the plant and equipment only has a residual value of 1.4, but its replacement cost is thought to be 2.1 million. All right, we hear that. Okay. And it says a comparable listed company has 80 million shares at current share price of 4.2 and made a profit after tax of that. The company has suffered that. All right. So let's look at the information we have here. What we do know is that the shareholders fund, because we know, if you remember how our balance sheet normally looks. For balance sheet, we say capital equal asset minus liability, right? So all our assets, for example, our total assets is 4.1 million, right? That's our total assets. Now, our total liability is, okay, they didn't add it up, but our total liability in this case will be the 1,310 and the 890. That's 2.2 million, right? 2.2 million. So asset minus liability will give you a net asset. That's what your net asset is, asset minus liability. Or you can just pick up your equity value, right? So asset of 4.1 million minus liability of 2.2 million give you your net assets of 1.9. All right. So 1.9 is a net asset, but we have some adjustments to make. For example, the property gone up by to $1.3 million. So we have to add 1.3 minus 780. We have to add that difference because your asset more is not 780 anymore, it's 1.3. We have to add that difference. What else? Your stock, right? Your stock go down by 90,000, right? So even though you have your inventory here of 560 gone down by 90, so you'd have to take that out. And then let's see anything else in the notes. The plant and equipment only has a residual value of 1.4. So, but now the replacement cost is not. If residual value is what you can sell it for. So let's see how much it's worth. 1.4. Oh, but you have it in the books for 2,230. So you have to bring down the value to 1.4. So pretty much you're going to have something kind of looking like this. Not a whole lot of workings, but the net asset value is $1.5 million. That's the 3 marks. All right, that's your 3 marks. Now your PE ratio, because they gave you a comparable listed company, they gave you some information. So they say now calculate your PE valuation. So our PE valuation is going to be this, and they ask you for other factors, which is, theory. So the PE based valuation, the EPS of a comparable company, they told you that a comparable company made $22 million and they have 80 million shares. That's what they told you. So the EPS of that company is 27.5 cents. I tell you that. The PE of the comparable company, they told you that the share price is $4.20. So the PE will be the $4.20 over the EPS over the 27.5 cents. That gives you a PE ratio of 15.3. But remember this, our share is not marketable. So we have to reduce the PE. Now, yes, in this question, they use 75%. But anything you reduce it to, is good. You just have to say, since our shares are not marketable, we will reduce the 15.32, where they say 11, 12, 13, or 14. That's good to go, right? Unless in the question they tell you that use 25% as the adjusting figure. But if they don't tell you, you just say, say you have to use a little lower number because your shares can't be sold. So they get to use 11.5 as the adjusted PE. Then how you're going to get your PE valuation? What is your profit after tax when you take out any adjustments that you need to make? It would be the 300 being your profit for the year. Plus now, what you're going to add now in terms of your salary savings, 70 million in savings salaries, but it has to be net of tax, right? The 300 plus 49 give you 349 million as your profit after tax. Profit after tax times PE gives you a value of the business being 4,014,000, right? So that basically gives you the value. The part B itself, for 2 marks, says consider other factors. Just give a few factors and then you're good to go, right? Other factors you need to take into consideration when you're valuing a company or valuing a business. right? And then the last question we have on the paper is question 5, which is foreign currency risk management question. So read it, you use 5 minutes, really try to do the forward market hedge and the money market hedge. So part A is an explanation, even if you want to use numbers, but it's just the part B I want you to focus on. I'll talk about the part A very briefly, and then we're going to look at the part B. So use 5 minutes, read it, probably 7 minutes, read it, try to do the forward market hedge and the money market hedge. So use your steps, look on it. Is it a foreign currency receipt or a foreign currency payment? Then do the money market, use the steps of the money market hedge, do the forward market hedge, that's one calculation. And then of course, compare which one is better. Should they use the forward market or should they use the money market? So I give you 7 minutes for that. And then we will go through the question in its entirety. And then we'll wrap up there because I'm unable to give you all a quiz. So we'll wrap up after this. And I'm going to let you all know what's the paper we're doing next week, as next week is our final session. I'd really want y'all to do the paper. I'm just going to spend a little bit of time on it because I want to do a recap of the topics next week. Since it's the final session, I want to do a recap of the key topics, key calculations, and then probably just a brief discussion of the other paper that we will do. The other paper I want to do is the BPP mock, the September 2019 BPP paper. That's the one I want you all to do so that I can spend maximum an hour on that and then use the other hour and a half in our session to go through the key topics, key calculations, and the basic approach that we can use, examination techniques we can utilize with regards to certain topics. All right, so 7 minutes, do what you can, and then let's complete question 5. All right, so let's go. Not a long one, so let's go. So part A basically says explain how inflation rates can be used to forecast exchange rate and then do an illustration. In essence, they are basically asking you to explain the principle behind purchasing power parity. The concept of purchasing power parity. What does PPP suggest? That's what they're asking you. Then possibly showing the formula and then using an example to work the formula. That's pretty much what they would want for those 4 marks. Then the part B says calculate for the forward market hedge. One thing we have to remember, the bank always wins. And the other thing, a money market hedge. So we know there are 3 to 4 steps that we have to follow, but then it depends. Is it a foreign currency receipt or foreign currency payment? So let's see. It says LTM, whose home currency is the dollar, has recently been awarded a contract by ACCA, whose home currency is the peso. So you get a contract. So you're going to get some money coming in, a foreign currency receipt of $20 million. That's what happens, guys. As a contract condition state that payment will be made in pesos. They're going to pay you pesos 6 months from now. The value of the contract is $20 million. So in this case, as you know, it's pretty much you're going to be receiving $20 million. So what is this? What are the steps for foreign currency receipt? For foreign currency receipt, we normally say the steps are borrow foreign currency today. Amount to be borrowed will be the expected receipt over 1 plus I. The I being the lending rate overseas prorated. Then we say convert at spot, so convert at today's spot rate. Remembering the bank always wins, so use the rate at which the bank give you the least amount of money and take as much money from you as possible. And then you are going to invest at home. Invest at home. And the result from that is going to be the amount that your step 2, which would be the amount that you receive from the cambio times 1 plus I. I in this case being the deposit rate at home prorated. So we know the steps. So it's just a matter of dropping in the numbers once you lay out the steps. So your solution would look something like this. For the part A, you just state what is PPP, drop in the formula, throw in some numbers to show them how you can do your calculations, right? The part B, forward market hedge, receiving 20 million pesos. What is the 6-month rate? They didn't give you the 6-month. Yes, they did. They gave you the 6-month forward rate. Which one are you going to use? Is it 12.06 or 12.892? 12.892. Why? That will give you the least amount of dollars, right? So the bank going to use that because the bank always win. So and then that done for the forward market hedge. For the money market hedge, we know it's a foreign currency receipt. So you're going to borrow some pesos today or step 1, right? Perfect. But how much you borrow? 19.1 million, right? For your pro rate, the borrowing rate overseas, that is a country in which there is pesos, the 9.1%, you have to prorate that to 6 months because it's 6 months, it's not 1 year. So you do 6 over 12 times 9.1%, and then that give you the 4.55. What you do next? Convert at spot. What is the spot rate now? 12.500 and 12.588. Which one the bank going to use? 12.588. Why? The bank always will. They're using the rate that give you the least amount of dollars possible. So that's the one they're going to use. Then the third step is invest at home. And how much you're going to get in terms of your receipt. The deposit rate at home is 3.7% for the year, but you're only depositing for 6 months, so you prorate it, you get 1.85%. When you do that, it means then that you're going to receive 1,547,784. So which one is better? Forward market. Forward market, you get 1.5 million, 1.5 million 51,350 versus the 1,547,784, right? So $3,000 more. I mean, it's not Jamaican, let's say it's US, and clearly that would be the better option. And that pretty much covers the paper. So those are the topics, those are the areas that are covered within the paper. As I said, I'm having serious internet problems. So this time was really need to do 2 of the quizzes, the online one. You can always go online anyway. Go to wayground.com and just try and find those quizzes, ACCA FM quizzes, revision quizzes, and try and attempt them as a means of practice, testing yourself in both two things in terms of time management and also knowledge. So that's pretty much it. Next week, we are going to be looking at the the mock paper that you have September on it, the September 2019 BPP mock. So, but I want y'all to attempt it because we'll only be quickly browsing through it as we want to utilize at least the last hour and a half of the class to go through with key topics, key areas, and key approaches on your examination techniques and moving forward for the exam. And then, of course, you can, after that, after Monday, then it will be up to you, in terms of setting your study timetable leading up to the exam. So this is where we would end this evening. So until next week, take care.